In this particular module, we're going to discuss who generates national income. National income is generated by the normal residents and the concept of NFIA, that is net factor income from abroad. We're also going to discuss domestic product at market price and domestic product at factor cost. And lastly, we're going to make a distinction between gross investment and net investment. Now, what is national income? National income has been defined as the sum of factor incomes earned by the normal residents of a country. The term normal resident is an important concept in national income. Now, who is a normal resident? A normal resident is said to be a person or an institution who ordinarily resides or is located in a country and whose center of economic interest lies in that country. But there are two conditions to become a normal resident of a country. First, his or her stay in the country should be more than a year, and interest of staying in that country should be economic. Now, what is meant by economic interest means the resident carries out the basic economic activities of earnings, spending, and accumulation from that location. Thus, there is a basic difference between the terms resident and citizen. A person is a citizen or national of a country in which he is born, or citizenship is allowed on some legal criterion. A person is treated a resident of a country on the basis of the economic criterion discussed above. A person can be a citizen of a country and a normal resident of some other country. For example, a large number of Indian nationals have settled in USA, England, etc. as residents and not as nationals of those countries. For India, they are non-resident Indians but are Indian nationals. All households in an economy are not equal to the resident households. The households are equal to resident plus the non-resident households. Following are not included under the category of normal residents: foreign tourists and visitors who visit a country for recreation, holidays, medical treatment, conferences, etc. Foreign staff of embassies, officials, diplomats, and members of the armed forces of a foreign country located in the given country. International organizations like UNO, WHO are not considered as normal residents of the country in which they operate. They are treated as the normal residents of international area. Employees of international organizations are considered as residents of the countries to which they belong and not of the international area. For example, an American working in UNO office located in India will be treated as the normal resident of America. Crew members of foreign vessels, commercial travelers, and seasonal workers are not treated as normal residents provided their stay is less than 1 year. And the border workers who live near the international border and cross the border on a regular basis to work in the other country, they are treated as the normal residents of the country where they live and not where they work. However, if the employees are working for more than 1 year in such international institutions, then they become the normal resident of a country in which such institutions are located. It means, in the given example, if the American is working in UNO office in India for more than a year, then he will be treated as the normal resident of India. NFIA, or net factor income from abroad, is significant to differentiate between domestic income and national income. Domestic income is estimated first, and then national income is derived from domestic income by adding NFIA to domestic income so as to get national income. Now, NFIA is equal to the difference between factor income received from rest of the world and factor income paid to rest of the world. So NFIA is equal to factor income earned from abroad minus factor income paid abroad. Now, factor income from abroad is the income earned by the normal residents of a country from rest of the world in the form of wages and salaries, rent, interest, dividend, and retained earnings. Factor income to abroad is the factor income paid to the normal residents of other countries, that is non-residents, for their factor services within the domestic territory. The difference of factor income from abroad and factor income to abroad is termed as net factor income from abroad, or popularly abbreviated as NFIA. And national income is equal to domestic income plus NFIA. NFIA is positive when income earned from abroad is more than the income paid to abroad. NFIA is negative when income earned from abroad is less than income paid to abroad. NFIA is 0 when income earned from abroad is equal to income paid to abroad. Now, what are the components of NFIA? Now, the first component is net compensation to employees. It refers to difference between income from work received by residents working, living, or employed abroad for less than 1 year, and similar payments made to non-resident workers staying or employed within the domestic territory of the country for less than 1 year. The second component is net income from property and entrepreneurship. It refers to difference between income from property and entrepreneurship in the form of rent, interest, and dividend received by residents of the country and similar payments made to the non-residents. And the third component is net retained earnings of resident companies abroad. It refers to difference between retained earnings of resident companies abroad and retained earnings of non-resident companies located within the domestic territory of a country. Now, what are retained earnings? Retained earnings refer to that part of profits which is kept as reserve after paying the corporate tax and dividends. Now we'll make a distinction between gross and net concepts of domestic product. Investment or capital formation refers to addition to the capital stock of an economy, for example, construction of a building, purchase of machinery, and addition to inventories of goods, etc. Investment can be looked up in two forms: gross investment, net investment. Gross investment is addition to the stock of capital before making allowance for depreciation. So capital stock consists of fixed assets and unsold stock. So gross investment is the expenditure on purchase of fixed assets and unsold stock during the accounting year. Now, when we talk about net investment, the actual addition made to the capital stock of economy in a given period is termed as net investment. Net investment is equal to gross investment minus depreciation. So when we talk about gross investment, it is inclusive of depreciation and makes no allowance for depreciation. And net investment is exclusive of depreciation. Now, what is depreciation? Depreciation refers to a fall in the value of fixed assets due to normal wear and tear, passage of time, or expected obsolescence due, which means change in technology. The concept of depreciation is important to differentiate between gross value and net value. While estimating national income and related aggregates, monetary value of final goods and services can be estimated in two ways: at factor cost and at market price. Now, what is factor cost? Factor cost refers to all the payments made by the producing unit to the factors of production for rendering productive services in the production of goods and services. Now, what is market price? Market price is the price at which a commodity is sold in the market. It is the price which the buyers pay for the commodity. Market price is the sum total of factor cost and net indirect taxes. So the equation is market price is equal to FC, that is factor cost plus NIT. Now, what is NIT? Net indirect tax. Net indirect tax is the difference between indirect taxes and subsidies. Now, what are indirect taxes? All taxes on goods and services during the production, that is on manufacturing, selling, excise duty, custom duty, are some of the examples of indirect taxes. These taxes raise the prices of goods and services produced. Mind you, this word raise the prices is very important. These are called indirect because burden of these taxes is shifted to buyers, although the responsibility of paying taxes is on the production units. Now, the second component of net indirect taxes is subsidies. Subsidies are financial assistance by the government to an enterprise on production of a certain commodity or a compensation for selling a good at a certain price fixed by the government, which is below the open market price. Now, when we talk about examples of subsidies are to encourage exports, to encourage employment. Subsidies reduce the prices of goods and services. Net indirect taxes are calculated to know the net impact of taxes on price of a commodity by subtracting subsidies from indirect taxes. So when we talk about NIT, we say NIT is equal to indirect taxes minus subsidies. So how do we arrive at market price from factor cost? So we add net indirect taxes to factor cost so as to arrive at market price. And when we subtract net indirect taxes from market price, we arrive at factor cost. So to restore parity between domestic product at market price and domestic product at factor cost, we subtract indirect taxes and we add subsidies, because indirect taxes raise the market price and subsidies lower the market price. It is with this adjustment that the two aggregates become equal. So your domestic product can either be in terms of factor cost or it could either be in terms of market price. So when we subtract NIT, that is IT plus subsidies, that is the combined effect of IT and subsidies gives us NIT. So when we subtract indirect taxes and add subsidies from GDP or NDP at market price, we arrive at GDP or NDP at factor cost. And factor cost, when we add NIT, that is we add indirect taxes and subtract subsidies, we arrive at GDP or NDP at market. So domestic product at market price or domestic product at factor cost are related by way of net indirect taxes, which is nothing but indirect taxes minus subsidies. So with this, we finish the distinction between domestic income and national income, gross and net concept of investment, and domestic product at market price and factor cost.